Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Alexander's Inc. Annual Report. Alexander's Inc. is a real estate investment trust, REIT, that offers various services through its manager, Vornado Realty Trust. The company has a diverse portfolio of properties in the greater New York City metropolitan area. One of Alexander's key business areas is property leasing and management. They lease out office and retail spaces to prominent tenants such as Bloomberg, LP, which occupies the world headquarters at 731 Lexington Avenue. This suggests that Alexander's provides commercial real estate services, including office space rentals. In addition to leasing, Alexander's also engages in property development and redevelopment. The Rigaud Center complex in Queens is a notable example of this, featuring retail properties and residential units like the Alexander Apartment Tower. This indicates that the company offers property development and construction services. Alexander's portfolio also includes retail properties located in Flushing, NY, which suggests that they provide retail space rentals and management services. Overall, Alexander's Inc. provides a range of real estate-related services, including leasing, management, development, and redevelopment of commercial and residential properties. Alexander's Inc. has experienced a significant increase in its stock price over the past year, rising by approximately 28.78%. Several key news events have contributed to this growth. One notable event was the restructuring of the $300 million mortgage loan on the retail condominium at 731 Lexington Avenue in Manhattan. This move improved the company's financial flexibility and reduced risk. Another factor that positively impacted the stock price was the refinancing of Rigaud Park II, a shopping center in Queens, New York. The company secured a favorable interest-only loan with terms set at SOFR plus 2%, leading to reduced interest expenses and improved cash flow. Consistent quarterly dividends also played a significant role in boosting investor sentiment. Alexander's Inc. declared regular quarterly dividends of $4.50 per share on common shares, attracting income-focused investors who demand consistent dividend payouts. These financial restructuring and refinancing activities, combined with continued dividend payments, have been strong positive catalysts for the company's stock performance. Alexander's Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $3 billion. Alexander's Inc. trades at a higher price-to-earnings ratio of 41 times and a higher price-to-book ratio of 10.61 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company exhibits a very high leverage profile, with liabilities accounting for 87% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 7.94%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline for a company can be complex and multifaceted. However, based on the extracted summaries, several key factors stand out. Revenue growth is primarily driven by Bloomberg's rental revenue, which accounts for 61% of total rental revenues. Trends in office real estate, including work-from-home arrangements and AI adoption, also play a significant role in driving revenue growth or decline. Economic downturns in New York City and the U.S. can negatively impact results of operations and financial condition. On the other hand, several factors can lead to revenue decline. These include industry slowdowns, interest rate fluctuations, relocations of businesses, changing demographics, work-from-home arrangements, loss of major tenants, damage to key properties, bankruptcy or insolvency of tenants, changes in space utilization by tenants, failure to renew leases on favorable terms, and decreased rental income due to leasing on less favorable terms. In addition, specific events such as the closure of a store at Rego Park II Shopping Center, the relocation of Burlington and Marshalls to Rego Park II, and the loss of the Home Depot as principal retail tenant at 731 Lexington Avenue can also impact revenue growth or decline. Overall, these factors highlight the importance of monitoring and adapting to changes in the market and industry to ensure continued revenue growth. The net income of a company decreased significantly over a period of 3 years. Initially, it dropped by 35% from $43,444,000 to $28,224,000. This decline continued in subsequent years, with further decreases in 2024 and 2025. The profit margins also saw a substantial decrease, dropping from 0.11% in the initial year to 13.2% in 2025. The reasons behind this decline are multifaceted. One major factor was the loss of significant tenants, including Bloomberg at 731 Lexington Avenue, which led to a decrease in rental revenues. Additionally, the bankruptcy or insolvency of other tenants further exacerbated the issue. The company also faced increased costs due to rising labor, materials, construction, and renovation expenses. Furthermore, the inability to raise rental rates at or above the rate of inflation contributed to the decline in profit margins. These factors collectively led to a substantial decrease in net income and profit margins over the 3-year period. The company is indeed generating positive operating cash flow. This is evident from the net cash provided by operating activities, which has been consistently increasing over the years. In 2025, the company generated a significant amount of $73,444,000 in operating cash flow. Even when compared to the previous year, 2024, where the company generated $54,106 in operating cash flow, it is clear that the company's ability to generate positive operating cash flow has improved over time. This trend suggests that the company is effectively managing its operations and generating sufficient cash to meet its financial obligations. The company's debt level has undergone significant changes in recent years. According to the extracted summaries, the debt level decreased by $201,611,000 from December 31, 2024 to December 31, 2025, page 30. This decrease is also reflected in other pages, such as page 38, where it states that the debt level decreased by $158,568 from 2024 to 2025. Additionally, page 58 notes a 19% decrease in debt level from $967,941 to $783,004. In contrast, interest expenses have increased due to refinancing and restructuring activities. For instance, on page 27, it is mentioned that the interest rate for Rego Park II Shopping Center refinancing was increased from SOFR plus 1.45% to SOFR plus 2%. Furthermore, on page 52, it is noted that interest expenses increased due to the restructuring of a $300 million mortgage loan on 731 Lexington Avenue retail condominium. Overall, while the debt level has decreased significantly, interest expenses have increased due to various refinancing and restructuring activities undertaken by the company. The performance of various segments and regions has been analyzed, revealing both positive and negative trends. In New York City, a notable trend emerged. The region experienced a decline in its net operating income, NOI, by 13% in 2025 compared to the previous year. This poor performance stands out as a significant deviation from the preceding years. On the other hand, New York City demonstrated good performance in both 2023 and 2024, with an increase of 1% in NOI from 2023 to 2024. This indicates that the region was able to maintain a steady growth trajectory before experiencing the decline in 2025. Management is expressing caution about the company's outlook due to various external factors that are beyond its control. The company operates in a highly competitive environment where success depends on global, national, and local economies. Additionally, fluctuations in real estate values and investments can impact business performance. The company is also concerned about potential uninsured losses due to inadequate insurance coverage, which could negatively affect the business, operations, and financial condition. Furthermore, inflation may lead to decreased profit margins, increased labor costs, and higher construction/renovation expenses. Management strategy focuses on leasing, managing, developing, and redeveloping properties in New York City, with a goal of holding onto these assets for longer periods to minimize impairment losses. However, the company is aware that its outlook remains uncertain due to external factors such as changes in tax laws and regulations. The company's financial performance reveals a notable aspect of its shareholder value distribution. On page 30, it is explicitly stated that the company has paid dividends amounting to $92,425,000. This indicates that the company has prioritized returning value to its shareholders through dividend payments. However, there is no mention or indication of share buybacks in the provided information. Concerns about inventory buildup and supply chain disruption have been raised due to several factors. One major concern is the potential loss of or damage to key facilities, such as the 731 Lexington Avenue location. This could lead to a significant disruption in operations and impact the ability to meet demand. Another issue that has been identified is material shortages. With various suppliers facing their own challenges, it may become difficult to obtain necessary materials on time, further exacerbating supply chain disruptions. These concerns highlight the need for careful planning and contingency measures to mitigate potential risks and ensure business continuity. That concludes the financial summary for Alexander S. Inc. Feel free to comment below, and I will be happy to answer them when possible.